Our next guest, Mark Fields, is the former CEO of Ford, a Qualcomm board member, and a senior advisor at TPG. Mark, this makes you perfectly positioned to talk about some of the key bottleneck challenges that have been facing this industry. When do you expect this to normalize?
Well, from the information that I'm looking at and folks that I'm talking to, you're really not going to see a normalization of this until well into next year. I mean, the bottom line, as you heard from Phil, is the auto industry is still firmly in the grip of this ongoing semiconductor chip shortage that doesn't show signs of abating because it's been exacerbated now by the COVID shutdowns in Asia, where a lot of the chips are obviously manufactured. And as you go forward, to put this into perspective, there's always things that are going on that are interrupting production, whether it's weather-wise, labor-wise. But in the past, the supply chains have been able to weather that because there's been enough supply in the system. Now, the supply chain is so tight, anytime there's an issue, whether it's labor or weather or whatever, you're going to see an immediate impact, and that's why you see those plants going down. So the bottom line is, the next 6 to 12 months, volatility in production is going to be the new norm in the industry.
Right. You bring up a really good point with there being just such limited margin of error or room for margin of error in the supply chain right now. When you speak about volatility over the next 6 to 12 months, what exactly does that look like?
Well, it looks like just like we've seen over the last few weeks, you see every manufacturer or car maker is coming out with their forecast for production. But those are basically points in time types of forecasts. You've seen in the last week, literally every major OEM cut production. Importantly, you've seen Toyota and Honda, who have managed so far so good, better than others through this chip shortage. But last month, Toyota said that they were going to cut about 40% of their global production in September. And Honda just notified their dealers here in the U.S. to expect about 40% less of deliveries over the next coming months. So you're starting to see this really impact the industry. And you heard from Phil the low inventory levels. I mean, the auto industry usually should have about 3 to 4 million units in stock right now. And now that's less than 1 million units. So you're going to see a lot of these plant closures that are going to pop up, and you're going to continue to see that volatility over the next number of months.
Mark, at some point as the year goes on, is this not going to shift into being a bit of a silver lining? Presumably the demand doesn't go away. The age of the average car on the road is still going higher. There shouldn't there next year, some more pent-up demand once the supply issues maybe get worked through? In the meantime, pricing has obviously benefited from the manufacturer's point of view through all this.
Yeah, you're exactly right. The good news is the underlying demand is there, but the inventory is not. And I think you're going to see that demand continue to be strong over the next couple of years. So what you're seeing in the system right now is you're seeing lower incentives by the automakers. They're getting record average transaction prices. You're seeing their margins being very good on the vehicles that they're selling, both for the automakers and the dealers. I think the issue going forward is as the system starts to normalize and have better flow of production, because that demand is going to remain strong, the inventory levels are going to take a longer time to kind of normalize. And so I think you're going to continue to see a lot of asphalt on dealer lots, even when the production starts to get more consistent because of that demand that's out there. And overall, when you step back, that's good for the industry.